Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
PPFAS Mutual Fund. There's only one right way.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
To start with, I will explain you all the abbreviations that I will be using in this presentation. So the first abbreviation is IND-AS, that stands for Indian Accounting Standards. They are the new accounting standards which are applicable from 1st April 2016. And second one is the IFRS, which is accepted globally except a few countries like US and Japan, which have their own accounting standards. US has US GAAP, US generally accepted accounting principles, and we'll start with it. So coming to the background, globally more than 140 countries follow IFRS or IFRS converged. So IFRS converged means that basically they follow IFRS only, but they have some exceptions to it. And among the large economies, only India, Japan and USA did not follow it. India is now coming to IFRS converged accounting standards. Japan has its own accounting standards, USA has US GAAP. India made a commitment towards this IFRS converged accounting standards at the G20 summit in 2009. But as we all know, there were some delays, and it will be applicable from 1st April 2016. So MCA, the Ministry of Corporate Affairs, issued a roadmap for this beginning April 2011, but then again there were some tax issues and they had to delay it. So while presenting the budget for the year 2014-15, it was proposed to adopt IND-AS in a phased manner from FY17 onwards. So it is a phased implementation. We'll look at it how it goes. So IND-AS is IFRS minus some carve-outs. Carve-outs are nothing but exceptions to the IFRS accounting standards. These carve-outs are meant to be suitable to the Indian companies for better presentation, for removal of some of the options that IFRS gives, and for facilitating some first-time adoption. So convergence means not adopting IFRS as it is. This is the phased implementation of the IND-AS. First year of adoption, 2016-17, will be applicable to all the listed companies who have net worth more than 500 crores and unlisted companies also having net worth more than 500 crores. The second phase will be applicable from 1st April 2017. It will be applicable to all the listed companies and the unlisted companies having net worth more than 250 crores. The third option is the voluntary adoption, and it can be adopted any time after 1st April 2015. One point here is that it is applicable to all the holding subsidiaries, joint ventures and associates. So if you have a holding company adopting IND-AS, the subsidiaries also have to compulsorily adopt the IND-AS. For BFSI, there are different timelines. So first year of adoption for the BFSI sector is FY19. So 1st April 2018 will be the implementation date, and it is applicable to all the scheduled banks and insurance companies. For NBFCs having net worth more than 500 crores, and again applicable to all the holding subsidiaries, JVs and associates. Phase 2 will be applicable from 1st April 2019 or FY20, and it will be applicable to all the banks were already covered in the first part. So it will be applicable to all the listed NBFCs and unlisted NBFCs having a net worth more than 250 crores but less than 500 crores. So assuming a company adopts Ind-AS from 1st April 2016, these will be the timelines that the company will have to follow. So we are here, say 1st April 2016. First quarter where they will report Ind-AS results is Q1 16-17, and first annual report will be FY 16-17. But at the same time, they will have to provide comparable financials for the previous year. So 15-16 is the previous year, and they will have to show a opening balance sheet on the transition date. So opening balance sheet as on 1st April 2015, they will have to show. Coming to some basic differences between IGAAP and Ind-AS. So IGAAP are the earlier accounting standards which were followed by the Indian companies, and Ind-AS are the new accounting standards. Under IGAAP, you used to show only profit and loss. Here you will show profit and loss and other comprehensive income. So what is covered under other comprehensive income we will cover later. And EPS you used to show before extraordinary items and after extraordinary items. Here equity EPS will be excluding other comprehensive income. So there is no extraordinary items that can be reported by the companies. Coming to some of the basic principles that Ind-AS covers. So substance over form versus legal form, which was covered in the earlier accounting standards. So substance over form means that what is on the face you don't take as it is, but you go behind the scenes and see what is there in the contracts. Fair valuation versus conservatism, increased disclosures in terms of the segmental information and reconciliation of some of the items like income tax. So what I will do is I will not go through each and every accounting standards. I will cover the major changes that have happened under Ind-AS and its impact on the listed companies that can be seen. So these are the major changes that we can see: consolidation and business combinations, revenue recognition, financial instruments, property, plant and equipment, employee benefits and others. We will cover each one one by one. So coming to consolidation and business combinations, the IGAAP, the earlier accounting standards, required consolidation only when a company had one or more subsidiary companies. But now under the new accounting standards, even if it has one or more joint ventures or associate companies and no subsidiaries, then also they will have to consolidate it. The major differences in this between the two is change in the definition of control, method of consolidation, and how to record gains or losses on the dilution of stake in their subsidiary companies. We'll again look at each one of them. So change in the definition of control was defined under the earlier accounting standards as having a equity stake over 50% and holding majority position in the board of directors. But under the new accounting standards, some other things also have to be considered, like veto rights with minority shareholders, potential voting rights, de facto control, structured entities to identify which are the subsidiaries. So all these basically relate to substance over form and what actually, who actually is controlling the company. Now coming to the accounting for associates and JVs, associates were consolidated using the equity method. What happens under equity method is it is shown as a one line item in the income statement. So whatever income you receive from the associate company, you add the investment in the associate company plus the income received from the associate company minus the dividends paid. So that is how one line item is shown in the income statement. And JVs were consolidated using the proportionate consolidation method. So under the proportionate consolidation method, each and every item according to the stake that they held. So if they held 51% stake, so 51% of each item was consolidated in the income statement. And under the Ind-AS, JVs also have to be consolidated using the equity method. So one line item for JVs and associates. That's how it will be shown now. If there is a sale in the stake of a subsidiary, what earlier used to happen is gain or loss on the sale of stake in the subsidiary was recognized in the income statement. But now, if you are still a holding company, holding shares in the subsidiary company, then the gain or loss is to be considered as an equity transaction and it cannot be passed to the income statement. If it ceases to be a subsidiary company, then it can be passed through the income statement. So you have to bifurcate whether it still is a subsidiary company or not. Coming to the revenue recognition principles, there are many types of contracts that we usually have. We'll cover some of the basic ones. So the definition for revenue recognition in the earlier accounting standard was, as long as there is transfer of significant risk and rewards to the customer, certainty of the consideration amount and certainty of the collection of the consideration amount, then you can recognize the revenue. But now what you have to do is you have to identify the contract, you have to separate the performance obligations, determine the transaction price, then allocate the transaction price to all the performance obligations, and you have to recognize it as and when each of the performance obligations is fulfilled. So the timeline might be extended. So there are many multiple element contracts. So something like free warranty or other services that are provided along with the product. So what used to happen earlier is they were recognized at the time of the sale of the product itself. But now you have to bifurcate the free warranty and the services part of it, and you recognize as and when it is actually redeemed by the customer. Coming to the service concession agreements, the PPP, public private partnership that we have with, between the government and the private companies. So under the earlier accounting standards, what used to happen is you account for the asset as the fixed asset and depreciate it over the concession period. You recognize the toll revenue, whatever you get in the income statement, and as and when the expenses are incurred, they are recognized in the income statement. But now under the Ind-AS, there is a different accounting treatment that is to be given. So you have to segregate the revenue for the construction of the asset and operation and maintenance of the asset. So for the construction of the asset, company will determine the fair value of the asset and recognize it in the balance sheet based on the percentage of completion method, which is followed by the real estate companies as of now. For the operation and maintenance, again it depends on whether the contract has been awarded based on rights or collection of revenues over a finite period. So again there is a bifurcation that has to be done over here. Coming to the transfer of control. So as I said in the earlier accounting standards, the revenue were recognized only when there is a transfer of significant risk and rewards. This was very subjective. But now under the new accounting standards, there should also be the transfer of control. So for the real estate companies, this is a big change. So real estate companies usually record it in percentage completion basis, but now again they will have to record based on the transfer of possession to the customers. There are some non-refundable upfront fees that are collected by the companies. So for example, companies in the BFSI sector, when they give a loan, they have these loan processing fees. So what happens now is that they recognize it in the first year itself when the loan is granted. But now what they will have to do is the upfront fees are to be deferred and they are recognized over the period of the rendering of the service. So if your loan is for 15 years, they will have to amortize it for 15 years. Coming to variable consideration contracts. So some contracts are contingent upon some things which are very uncertain. So accounting for that used to happen is that revenues are recognized upfront and expenses are recognized as and when the contingency arises. What will happen under the Ind-AS is that company needs to estimate and provide for the variability in the consideration. and recorded at the inception of the contract. All the discounts, rebates will have to be netted from the revenue. Gross revenues are not to be shown. All the discounts and rebates have to be deducted and shown in the income statement. Coming to the customer loyalty program, so this will be applicable for all the retail companies, airline companies who have these loyalty programs going on. So earlier we didn't have any specific accounting guidelines for this, and the companies were given an option whether to expense it when it is redeemed or provision, create a provision for it. But under the new accounting standards, there is no option given. The company needs to estimate the amount and it needs to bifurcate that revenue from the sale of the product and recognize it as and when the points are redeemed. So this is a bit complicated process for the companies, but they will have to do it. Coming to the excise duty part. So what happens under the current accounting standards is that revenue is showed net of the excise duty, but now they will have to show the gross revenues, and then excise duty is to be considered as a part of the raw materials consumed. So this will be a big change in the income statements of alcoholic beverages companies who have 50-60% excise duties. So their revenues might increase, but you might see a big jump in the revenues, but then you will have to see that excise duty will be a part of the cost of materials consumed. Coming to the accounting for the financial instruments or the investments that the companies have. So there are some major changes here. Non-convertible preference shares are to be classified as debt, and their corresponding cost is to be recognized as in the income statement itself. So this will be this will have a decline in the EPS for the companies having preference share capital and a corresponding increase in the debt to equity ratio for them. The perpetual debentures or compulsorily convertible debentures have to be classified as equity, and their finance cost is to be included in the equity cost. Coming to the valuation of financial instruments, so under the earlier accounting standards, what used to happen is that long-term investments were measured at the historical cost, and if there is a impairment in the cost of the value of the asset, then they have to reduce it from the historical cost. And the current investments were valued at cost or market value, whichever is less. Under the new accounting standards, the instruments have to be recorded at fair value, and fair value has to be applied to the debt instruments that they hold as well as the equity that they hold. One exception to this rule is that if you are a holding company and having investment in subsidiaries, JVs, associates, then either they can be recorded at cost or they can be recorded at fair value. But if you record it at fair value, then the change in the value of the assets have to be recorded through the other comprehensive income, which will not be a part of the EPS. So if there is say Maharashtra Scooters or Bajaj Holdings, they have a stake in Bajaj Finserv and Bajaj Finance. If the shares of Bajaj Finance or Bajaj Finserv run up, then and if these companies recorded at fair value, then they will have to pass that through the other comprehensive income, and it will not be a part of the EPS, or they can record it at cost itself. Coming to the property, plant and equipment. So there are some areas of conflict here. Capitalization of the exchange fluctuation losses or gains, depreciation of the revalue assets, amortization of intangible assets, and lease accounting for deemed leases. We will see each one of them. So under the earlier accounting standards, which was AS 11, it was amended and it allowed the companies to capitalize the exchange fluctuation on long-term assets, either in the value of the assets or through a reserve called the foreign currency translation reserve. and it was amortized through the income statement either over the life of the asset or FY20, whichever is earlier. So companies which have adopted this method can adopt it now also, even after the implementation of Ind-AS, but going forward the companies will not be able to take this option. They will have to compulsorily pass through the income statement and not capitalize it. Coming to the revaluation of assets, so under the earlier accounting standards, the assets could be revalued selectively. Some of the assets under a asset class could be revalued, and depreciation was passed to the reserve called the revaluation reserve. But under the new accounting standards, revaluation has to be done for the entire class of assets and not selectively. Also, the depreciation on this has to go through the income statement, even though the revaluation gains are adjusted in the revaluation reserve. So revaluation gains will be go to the reserves only, but the depreciation on the revalued assets will go through the income statement and not the reserves. Coming to the intangible assets, so under the IGAAP, which are the earlier accounting standards, the intangible assets were to be amortized for a period not exceeding 10 years. But now they can have an indefinite useful life and need not be amortized. But they have to be tested periodically for any impairment in the intangible assets. This is a grey area which can be used by a few companies to not amortize it and show higher profits. So let's see what happens. Coming to deemed lease. So Ind-AS and IGAAP, the earlier accounting standards and the new accounting standards, both of them are consistent in the accounting for the deemed leases. But there is a change in the definition of the deemed lease. We will see what it is. So many companies in the auto, pharma and consumer sectors have enjoyed high return ratios because they have these asset light models where manufacturing is outsourced. But there will be a change in accounting for this. We will see how. So under the new accounting standards, the companies will have to recognize additional tangible assets and financial liabilities on their books. But what are the conditions to be classified as a deemed lease under the Ind-AS? So it requires the use of a specific asset and convey to the counterparty right to use the asset while it takes significant proportion of the output of the asset, as evidenced by, there are three conditions for this: the purchaser has the right or the ability to operate the asset or direct others to operate the asset in the manner it determines. Second condition is the purchaser has the right and the ability to control the physical access to the underlying asset. And the third one is the price that the purchaser pays for the output is neither contractually fixed per unit nor it is the current market price per unit. So these are the conditions to be classified as a deemed lease now. So arrangements that may fall under the definition of the deemed lease are outsourcing agreements, take or pay contracts, arrangements in the telecom industry in which the supplier of the network capacity enters into a contract with the to provide purchasers with the right to capacity. Coming to the employee benefits and the accounting for the ESOPs. So under the earlier accounting standards, ESOPs were recorded either at the intrinsic value or at the fair value. The option was given to the company. But under the new accounting standards, they have to be recognized at fair value only. So this might increase the cost for some of the companies who give high ESOPs. Coming to some other changes, so proposed dividend. What used to happen in the earlier IGAAP is that the liability for the proposed dividend was recognized in the year in which it was declared. So if in Feb or March the board of directors declared the dividend, it is recognized as a provision for dividend in the annual report that you see. But now what will happen is that liability has to be provided only after it is passed by the shareholders. So the AGM happens in June to September. When the shareholders approve it, in that year they have to record the provision for dividend. So there will be a 1 year lag in the provision for dividend. Coming to some extraordinary items, so disclosure of items as extraordinary items is not permissible under the new accounting standards, either on the face of the P&L statement or in the notes to accounts. Nowhere they can declare any expense or income as extraordinary items. However, to provide greater clarity to the investors, the management may at its own discretion declare or exhibit such extraordinary items in the management discussion and analysis that they give. So in their speech, chairman's speech, or they can say that this much is extraordinary, but in the financial statements they can't declare anything extraordinary. Coming to treasury shares, yes sir. Yeah.
When you said you can't record extraordinary income and then you say that the EPS doesn't include extraordinary income, so how does it actually work?
Extraordinary income is separate and other comprehensive income is separate.
So let's say a company has a profit of 40 crores and it has sold land worth 40 crores. So total profit is 80 crores. Now here it says that you cannot show it that 40 crores as extraordinary income, but it is extraordinary. So where does it go?
So it goes in the other comprehensive income, which will be a part of the P&L, but it will not be a part of the EPS.
So you are just changing the words basically.
You are changing the words, and extraordinary items used to be before the EPS is calculated. So it will be accounted in the EPS. But now it will not be accounted in the EPS, it will be without those items.
Okay.
Yeah.
So Noel, just to clarify, the EPS will be based on P&L, which is reported after at the end of the profit and loss account. That profit and loss account figure will get carried over to the other comprehensive income, and after adjustments of other comprehensive income there will be an ending figure, but that ending figure is not to be taken for EPS. EPS is only profit. The bottom number of profit shown in the P&L account.
You don't want to fool around with it. Recurring things will not. You got a clean EPS basically.
A clean EPS, because otherwise each year people would say this is extraordinary, that is extraordinary. Those games can't be played anymore.
And what happens if a guy has FMP is maturing over 3 years? Then what happens?
So now FMP accounting has also changed. You have to account it at fair value every quarter or every year. So the FMP gains will not be accounted at a time of the maturity, but it will be accounted over the period of the FMP.
They won't know how much they'll get after 3 years. They won't
As on that date, so for the quarter ending 31st December, what is the market value and what was the market value on 30th September? The difference has to be, so mark to market basically. Coming to treasury shares, so some companies have treasury shares. The new accounting standards does not recognize the treasury shares as financial assets, and they have to be adjusted in the equity. Also, gains or losses on the sale of these treasury shares don't need to be recognized, and this will result in a reduction in the net worth of the company and increase in the reported EPS for those companies who have treasury shares. So this is one of the big changes in the Ind-AS which I came across very recently. So the NPA recognition for the banks and the BFSI sector. So what currently happens is that NPA recognition happens as per the RBI policy, and it is more in line with the loss incurred method or percentage provisioning method. So they provide a certain percentage of the bad loans. But what they have to do now in the new accounting standards is that they have to determine expected credit loss. So they have to build a model in which they say that this loan is expected to go bad, and accordingly they will have to recognize it. Even before it turns bad, they have to recognize it. This is still a grey area. All the banks have asked for the clarifications from the government, and it needs to be clarified. Some other disclosures which are mandatory under the new accounting standards are detailed disclosures on the management estimates used in the accounting policies. The definition of related party has been widened to include some more related parties. And segmental disclosures have to be detailed as if the chief operating decision maker makes the decisions based on the different segments. They have to declare contingent assets along with the liabilities. So what happens now is you only show contingent liabilities, but now you have to show contingent assets also. So if there is a case going on and you are expected to win the case and get some money, that becomes a contingent asset. It's dependent on the case hearing. You have to provide a reconciliation of net worth at the time of the adoption of the Ind-AS and reconciliation of the effective tax expense with actual tax expense, deferred tax assets and movement in the deferred tax assets or liability balances. Also, there has to be a detailed disclosure on capital management and capital allocation, which will benefit the investors hopefully. And some risk assumptions also have to be spelled out. So how does it impact different sectors? We'll just have a look at it briefly. Some of the impact is only cosmetic in nature, where you only change the head or the classification, but some of it will change the profit and loss statement and the balance sheet and the way you look at valuations and companies. So in the BFSI, there will be earlier recognition of NPAs, there will be fair valuation of ESOPs, deferment in the recognition of processing fees that they receive, routing the actuarial gains or losses through the reserves. For the FMCG and IT companies, again ESOPs is a big part, and accrual based recognition of the income on mutual funds, say FMPs or any other debt mutual funds that they have. For auto companies, there are lots and lots of JVs and associate companies that they have will now have to be either accounted under the equity method or consolidated, and there will be cancellation of treasury shares that they have, and many companies have take or pay arrangements with the outsourcers, so whether that will be classified as a deemed lease or not has to be seen. For media companies, fair valuation of ESOPs, again classifying redeemable preference shares as debt. So many media companies also have preference shares, so that will be classified as debt, and the cost has to be recognized in the income statement. So conclusion, there could be a drastic change in the EPS, the valuations, the return ratios, EBITDA margins, almost all the ratios, and the way you look at valuations will change. Any questions?
The brand values, I saw one balance sheet of Heinz, and I found bulk of the balance sheet was the brand value of Heinz, but we don't see that in Indian balance sheets. So is it not allowed, or is it coming now with this, or is not there?
Brand value, if you can.
So maybe we need to check on this, but as far as my recollection goes, how it gets accounted, or it used to get accounted historically in India, was this. Whenever an acquisition was made, a merger was made in India, typically you would add the assets to the respective heads. So debtors would get added to debtors, fixed assets would get added to fixed assets, liabilities, creditors to creditors, and whatever was the difference in the purchase price over and above the book value of what you were buying, typically it would go to goodwill. There was no segregation for this much is going for brand, this much is going for patent, or anything like that. There used to be one omnibus goodwill account. That's my understanding. Maybe we can check it again.
Will be more litigation or less after this?
So it's still very subjective, and some of the things are still gray areas. So how you look at it and how the companies look at it is. So companies will find a way to find the loopholes and do it, but we'll see.
At somewhere you talked about fair valuation of assets. It has to be done necessarily for all companies.
So if you are a holding company and holding investments in subsidiaries, JVs or associates, then you have an option. But other than that, it is compulsory. The only exception is the holding company.
Fair value of investments, not all assets.
Fair value of investments.
So if you own a plant, you don't have to value it every year. You just take it at historical cost minus depreciation.
And generally, how one would arrive at fair valuation?
So usually most of them are quoted investments, so traded on the market, you can get that.
You said there's some changes in the valuations as well. So apart from EPS, can you quickly tell us how it would affect the other ratios?
So if a auto company has an outsourcing agreement with a JV partner or some other company and it is classified as a deemed lease, then they will have to recognize assets and liabilities in their balance sheet. That will impact their return ratios and everything. And in turn that will affect the valuations.
And what about the debt over equity? You said the debt over equity ratio also gets affected.
So some preference capital needs to be recognized as debt, and that will increase the debt compared to the equity. So that will again change.
So if a company has take or pay contract with some other party, and that party has some liability on its balance sheet, then that liability has to appear here.
Yes. But certain conditions which I mentioned have to be fulfilled, then only it will be classified as a deemed lease.
So when we had a similar presentation in our office, and from just a plain reading of this, it sounds very significant. Whether companies actually end up doing all of this or not, or whether there are some conditions which allow them to escape, we do not know. But otherwise, just let's think about some sectors and companies. So if a auto manufacturer has a auto ancillary where 100% of that output is taken by the auto manufacturer, then effectively you would have to bolt on the entire balance sheet of the ancillary to the main company. Or an airline which is leasing aircrafts, then the entire aircraft comes on their balance sheet, the entire debt comes on their balance sheet. So right now we have just seen the guidelines. Quarterly results have been coming in. Again, a lot of these are unaudited. The first balance sheets are not out yet under the new accounting standard. Those first balance sheets will be out post 31st March, whenever those annual reports come out. And it will be interesting to see how the balance sheets look in some of these cases. On the face of it, it looks quite significant compared to the way we have been doing things in the past.
So in the presentation on slide 13, yeah, you're just talking about potential voting rights. Can you just throw some more light on that?
So if some shareholders have a clause which says that they have more voting rights, then they might be considered as having control over the company, and the company might be considered as a subsidiary company, and it might have to be consolidated. So yeah.
So if they have, meaning, so this is something which will be measurable, right?
Yeah.
Voting rights. So how do you say that it is potential in that sense?
So in US we have companies having A class, B class, C class, where some class of shares have more voting rights than the others. So those will be classified as having control over the company.
On slide 17, there's just one more, which is performance obligation. Yeah, the identify separate performance obligation in the contract. What would that mean?
So in a contract you would typically have certain bifurcations where you can bifurcate the contract into some parts. One part of the contract has to be performed now, second part has to be performed later on after the first part is done. So you have to bifurcate them and recognize it as and when that part is completed. So even in warranties and everything, as I mentioned, so you have to separate that, and as and when the warranty is actually redeemed by the customer, you recognize that.
Also, if we can go to that once more slide is on the preference shares.
Yeah. This one?
So if we are considering non-convertible preference shares as debt, yeah, so this will help increase the debt equity. Okay. Because it's now
This
part
will
of debt
increase, yeah. And the
declared
cost will be
increase-
declared in the income statement.
So the cost, meaning the dividend which you are supposed
Yes,
to be paying, will
yes.
be now.
It is as good as
counted in the
interest
P&L.
cost.
Okay, that is how the
And
factoring.
it will be
Fine.
accounted in the income statement.
Okay, and one last point, if I
Yeah.
can just ask,
Yeah,
is
sure.
the sector-wise impact which you showed in the
Hmm.
48 or some slide just before the end. Yeah. So the second point on FMCG and
Yes.
IT, would deemed lease be something which will really affect FMCG more? And maybe I just want to know if you have not highlighted it. So deemed lease, the concept of that, will now have more.
So it will depend on company to company, what sort of contracts that they have with their vendors. It depends on company to company.
So by and large, most of the FMCGs focus on brand and do the.
But they might not have the full control over the plant or the outsourcer.
Okay.
Say to just give an example, the tiles and the ceramic players usually have a contract with the outsourcers that they will take 100% of their output. So in that case, they will have to account for that in their balance sheet.
Okay, fine. Thank you
Yeah.
very much. Thanks.
They may also just reword the agreement to fall out of the ambit. So we still have to see how it plays out. They may take 95% instead of 100%. Those people will start doing some more work for. So we have to see how things pan out. No one would want those balance sheets to be bolted onto the main listed company.
They enjoy high ROE because of that, and that is their strength in terms of commanding high valuation.
I don't think people will bolt on the. I don't think the people will bolt on those balance sheets. Practically, they don't owe that money, and there's no recourse. So, if a banker has lent money to one of the outsourcers, they can't go to the FMCG company and demand repayment. So, even practically, those are separate business entities, and the P&L is separate. So, it doesn't make sense to add on everything, and maybe it will just involve going through the agreement with in some detail and ensure that the agreement falls outside this ambit, and there's no forced take or pay or 100% buyback kind of thing. This clause, I would be very surprised if it affects companies like Lever or things like that.
Any connection with GST?
Sorry?
Any alignment with the GST?
No, those are two separate things.
That's again another confusing thing. We had a similar thing in office, and it's not as simple as it was being portrayed or as people think it is.
I'm just curious, is there any reference made to treatment of R&D costs?
No, nothing.
Zero. So that stands.
That stands as it is.
Wow. Okay, thanks.
Yeah.
Any more questions? Cool, if we're done then we can break for drinks and dinner. Thanks so much.
The next FOF will be held on 23rd March, Thursday. Yeah. Thanks. Welcome.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
right way.
PPFAS Mutual Fund. There's only one right way.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.